Hello, everyone, and welcome to this Retail Investor webinar hosted by NZX. My name is Doug Vrame. I'm with the Issuer Relationships team at NZX. Today, we've got three presenters. Two of the presenters are listed companies on NZX, and one is an emerging financial platform, which we'll hear about. We're happy they've taken the time to put some thoughts together and speak to the group. Just a reminder of the format. We'll hear from each issuer for 15 minutes, followed by 5 minutes of Q&A. We definitely encourage you to ask questions, and the way you do that is there's a tick box up in your webcam kind of control panel. You can ask questions there. They'll come to us, and then we'll ask them to the presenter after each one. So let's get started. You can see Mark on the screen. We've got Mark England from Genesis, the CEO of Genesis Energy. Genesis is New Zealand's largest energy retailer with almost 500,000 electricity, natural gas, and LPG customers. Mark joined in May 2016 and is responsible for the leadership, strategic direction, and management of all its business interests. So I will turn it over to Mark now, and then we'll hear back in a few minutes with questions. So Mark, take from here.
Thanks, Doug. Kia ora, tēnā koutou, tēnā tātou katoa, ko Mark England aho, tēnā te wiki o te reo Maui. Good morning, I'm Mark England, and this is Maori Language Week for those of you that didn't know. Welcome to this presentation on Genesis Energy. Genesis, which is still 51% government owned, listed on the NZX in 2014, and we have a free float of 49% of our shareholding. Since then, we've delivered close to 1.5 billion of dividends back to shareholders, both large and small, over the last 7 or so years. And since I became CEO in 2016, after the IPO, about 2 years after the IPO, we've delivered a healthy return of about 17% total shareholder return to our shareholders. But hopefully, as you hear me speak through this presentation, you'll see there's more to come. We've got an exciting decade ahead of us, and I'm looking forward to taking you through it in a short 10 or 15 minutes. I'm going to skip the profile here on slide 2 and go straight to who we are. So many of you will understand Genesis. You'll have a view on who we are, but this slide I like to use to just set everyone in the right base. We do have about 480,000 customers. That is actual customers, not necessarily meter points. So if a customer has more than one fuel with us, we count them as one customer. And we are a retailer of 3 fuels, as Doug mentioned: electricity, gas, and LPG. And LPG has been one of the biggest contributors to our growth over the last few years. It's a growing fuel in New Zealand for lots of good reasons. On the right-hand side, you can see the map of New Zealand and see where our assets sit, really from the South Island, where we have the Tekapō power scheme, 185 megawatt hydro scheme, all the way up to Huntly in the north. We've got 3 hydro schemes, 1 thermal plant, and more recently the Waipipi wind farm, which was built in partnership with Tilt Renewables, and was up and running from the early part of this year. We've got some more exciting projects which I'll come to around renewables as we go forward. But what makes Genesis slightly unique in the generation space is our North and South Island mix, and also our mix between hydro, wind, and thermal. You can see all the little orange dots on this slide also represent the LPG depots. So we've got about 25 LPG depots spread around the country, manned by anything from 2 or 3 people through to sort of 30 or 40 people. So a growing part of our business, as I said, an important fuel in New Zealand's energy mix. Bottom right-hand corner is our dividend yield. So if you invest in our shares today, that's the return you would get, and it's a pretty healthy yield given current interest rates. So stepping back a little bit, and what are we all about as a company? Well, right in the middle of this rose, we call it, we have our purpose, and it's to empower New Zealand's sustainable future. And we mean that. It's not just a bluff statement. It's not greenwashing. We talk internally and externally with employees, customers, and other stakeholders around what our role is in New Zealand's future. I'll come back to that a bit more in detail, but around the edge of that, you can see we want to be customers' first choice for energy management, and at the bottom, an active enabler of New Zealand's energy transition. Those are our dual visions for our retail and our wholesale businesses. In our customer business, which we've been driving growth through for the last 5 years, we very much want to turn the model on its head from being one where everyone receives a bill for consuming electrons or molecules to one where we actively support our customers with the choices they have in their homes. So if you're a customer of Genesis today, you'll have experienced things like our Power Shout, you'll have seen Home Comparison, you'll have seen Eco Tracker, tools in our Energy IQ app that help give you the information you need to make the choices you want to make in your life, whether that be reduce your energy consumption, become more efficient, or reduce your carbon footprint and use less. So there's lots of interesting insights, and we continue to innovate and use tech and digital to make sure our customers get as much knowledge as they possibly can. On the right-hand side here, we talk about really the outcomes we're seeking. One is distinctive customer experiences. We don't want to just be a traditional retailer of energy, as I've said. We want distinct customer experiences, improve customer engagement, and improve net promoter scores as a result. We have signed up to limit climate change to 1.5 degrees of global warming. That's really important. We signed last year up to a science-based target. Now, that is an audited target that goes through a process with the New Zealand government and a body in New York. It's a process that came out of one of the COPs a few years ago. And we had to demonstrate how we were going to reduce our carbon exposure, both through Scope 1, 2, and Scope 3 emissions over the next period of time. And we've committed to do that by 2025. And I'll talk about that goal in a bit more detail in a second. Through all that, and through our generation mix, the diversity of our business across different assets, retail and wholesale, multiple fuels in retail, we plan and have done historically to deliver stable, growing earnings. So as we move into the 2020s, we expect to continue to grow and be able to support a growing dividend as we go too, and that's really important to us as we move forward. One of the messages I want to land today is about Genesis's role as the backbone of the energy system. You hear a lot in New Zealand about electricity, not much about the energy mix and energy choices that we have between the different energy sources. This is a bit of a complicated slide, but on the left-hand side, we're showing how the gas and coal fuel supply into Huntly enables us to ensure that not only do the lights stay on for electricity in New Zealand, but also that we can support businesses who need gas. We create a lot of flexibility in our fuel book. We create a lot of value through that, but we also create a lot of stability, which is why we call it the backbone of the energy system. We have contracts from Huntly Power Station with all our competitors in different ways, short and long term, in order to ensure that a very highly renewable and weather-dependent electricity market can continue to operate. And it's a contentious issue, but it's a real issue. At 85% renewable today in New Zealand, moving towards 95% renewable this decade, it's going to become increasingly important that we can ensure that electricity system is stable, reliable, and can continue to support the decarbonising of other sectors. One of the less talked about things in New Zealand is how electricity can be a really powerful tool for decarbonising the economy more broadly. And we have a huge advantage over many other economies around the world that are still sitting at 20, 30, 40% renewable electricity, in that at 85 going to 95 this decade, we can support the decarbonising of other sectors. Now, to do that, we also need to ensure that we can create stable electricity supplies. And that's what this chart is somewhat showing. On the right-hand side, while we've had a terrible FY21 in terms of carbon emissions and coal consumption because of a really, really dry country over particularly last summer and last winter, but also a shortage of gas supplies. So we've peaked in coal consumption, and our forecast here is that we won't see that level of coal consumption again. And the chart on the right-hand side shows that coming down quite quickly this year and then declining to the mid-2020s. Part of that is normal hydrology, but part of that is also the work that Genesis and others are doing to build more renewables and to decarbonize what we call baseload thermal. So that's this slide. I'm going to start on the bottom right-hand and show you that the trajectory is building gradually towards a mid-decade point where we will have displaced almost 2,000 gigawatt hours of what's now considered baseload thermal generation, meaning it's always on with new renewables. Those new renewables will also be cheaper than it's currently costing us to run that thermal plant. And that's a really important trajectory. We're doing that through a program we call Futuregen. And Futuregen involves partially contracting, like we have with the Waipipi Wind Farm and Tilt Renewables, and also building some of our own solar. So this slide talks to that. So we're planning to co-develop solar in New Zealand up to about 500 megawatts over the next 5 years. And we're in the final stages of choosing a global partner to work with us on that. And we should be able to announce that by Christmas. What's really important about this is not only does it mean Genesis is playing a role in investing and building new renewables, but solar is a really important part or component of the energy mix in New Zealand that hasn't really materialized yet. There's lots of announcements going on around the market, but we're really excited because within our portfolio, we see it playing a really important role. One of the things about solar that's interesting, but not obvious, but not necessarily a surprise, is that it's more predictable than wind. One of the biggest challenges markets that have a lot of wind in the system have is the wind can be very unpredictable. It can drop in and out very quickly. And if you're trying to balance demand and supply, you've got to have something else to turn on to fill the gap in that wind. Solar, bizarrely, amazingly, although it doesn't produce at night, is much more predictable during the day given weather forecasts. So that's really important to us. It can't solve everything, and one of the most important things to understand about this sector, particularly electricity, is there's no silver bullet. We're going to need a mix of renewables of different types in order to ensure that we can get the right outcome for New Zealand over the long term and build enough renewables to make sure that we can decarbonise other sectors too. So I'm going to summarize with really our commitments and then why Genesis. So I've said distinct customer experiences. We're really passionate at Genesis about innovating for customers, large and small. We're supporting a lot of large businesses these days in supporting them to reduce their carbon emissions and to also help them become more efficient and consume less energy when they don't need it. It's really important to us with our residential base that customers start to engage more. And as I said, if you've been a customer in Genesis, you'll see us nagging you to try and engage with the Energy IQ app to try and get you to think about when you consume energy, choose when you take your power shouts. And while that's not for everyone, some people just want to pay their bill and turn their lights on. The more consumers engage, the more consumers will be able to make the choices that matter to them, whether that be the environment or their cost structure. And our commitment to climate change, empowering New Zealand's sustainable future, is about what we're doing as a business, but it's also about the role we as a business will play in New Zealand's journey. It's also about what we do as individuals. Our office in Auckland is a 6-star green rated building. It's energy efficient. We don't have any car parks for employees. People ride their bikes to get public transport. And so increasingly building a culture within Genesis where people do their part for climate change, as well as we as a business do our part. And then stable, diverse earnings. We've issued guidance for FY22, the financial year we're in now, of 420 to 440 million EBITDA. That'll be growth on the prior year. And we should continue to grow through the early 2020s as we decarbonise the base with lower cost renewable generation, as I mentioned. So if you're thinking about investing in Genesis, why Genesis? Well, the backbone of the New Zealand energy system. We're really critical to ensuring that New Zealand operates effectively in energy. And it is an investment in the electrification of New Zealand, as I said. So the more renewable energy we can build and the more stable it is, the more we can decarbonise transport, industrial heat processing, two really big emitters in New Zealand. And you know, if you invest in Genesis, you are backing the single biggest carbon reducer over the next 5 years. We will take 1.2 million tonnes of annual emissions out of our book between now and 2025, or between 2020 and 2025, and that's the science-based target commitment. And as I mentioned, a retail business with a difference, one that will continue to use technology and digital applications to engage customers in the journey. So that's it for me, but I'm happy to take any questions and hand over to Doug.
Awesome, thanks, Mark. Really appreciate that and taking the time to put together that information. And we do have some questions that have come in, and I'll try and summarize. There are a couple questions about Huntly, and there's two that I'll kind of wrap into one. One's asking, when will Huntly be decommissioned, and what will be the impact on investors? And then kind of as a side to that, how does Genesis plan to support new technology required to realistically replace assets like Huntly?
Yeah, so Huntly is several things. Huntly is a gas-fired power station, and then it has coal-fired units. The coal-fired units can actually run on gas or coal. So we've got 2 fuels coming into Huntly today, and 4 units that run on a reasonably regular basis, and a 5th one that can be turned on in emergencies, which is what happened earlier this year. Huntly is not going away very soon. So people talk about this concept of decommissioning, but it just doesn't look plausible to us. It sits there in the artery between Auckland and Hamilton on the Waikato River, on a highway that's accessible with an employment base around. It's got a gas pipeline coming in from Taranaki. It's going to be incredibly important to the transition to a lower carbon future. So don't look at Huntly as the problem, look at Huntly as the solution to ensuring we can enable a stable energy system to decarbonise New Zealand. That said, we would like to think we can get rid of coal. Coal is twice the emissions of gas. We do need more certainty around gas policy and gas supplies over the next 10, 15 years. But gas should play the majority of the backup role in New Zealand in the future, not coal. We're also experimenting with biomass. We've got a pilot that's going to start there in first quarter of 2022 to see if we can run some of the boilers on biomass. The challenge will be the supply of biomass in New Zealand is quite short, and we're going to need to get that supply chain working. But we're keeping our options open, and we're working very closely with the government on that. So don't look at Huntly as something that's going to be decommissioned anytime soon, but it will evolve and it will become more renewable, less carbon emitting, but equally critical to a stable journey to a lower carbon future for the country.
Excellent, thanks, Mark. We do have more. I'll ask you a quick one here. Can you talk about the potential risk in terms of regulators looking to split up the gentailers?
Yeah, that's a popular narrative amongst smaller retailers. I think the risk is low. It would be very complicated to do it, so there's the practicalities of doing it, but put those aside. The gentailer model has served New Zealand really well, and regulators and politicians understand that. And you know, there's always a little bit of argumentative behavior between small and large companies, and everyone loves the small David versus Goliath argument. But ultimately, if we want to decarbonize New Zealand over the next 15 years, we want the electricity sector to do the heavy lifting, we're going to need these integrated companies who are going to invest, we think, about $4 to $5 billion over the next few years. In fact, about $4 billion has already been announced in enabling that. Splitting them up right now would be the worst thing you could do. It would disincentivize investment. You'd have many smaller companies with less balance sheet firepower to go and do the investment, and it just wouldn't work. So we think regulators and the government understand that, but of course there's a popular narrative out there, and it is often against the big companies. But my argument to all of you is look at the big companies as doing the heavy lifting and worth backing as we move to a more renewable future.
Excellent, thank you. So we are kind of pushing time. There are more questions. I'm going to ask one more that is another kind of theme coming up in the chat, talking about the comparisons, and can you speak to the comparisons between hydro and solar, and what the advantages that are of hydro?
Well, one of the beautiful things about New Zealand's energy system is hydro. It's about 60% hydro today. And one of the less discussed things about hydro is it can be turned on really quickly. So unlike a coal-fired power station, which takes 10 or 12 hours to ramp up, hydro can be turned on really quickly as long as it's there. The weakness in the hydro system in New Zealand is there isn't much storage. So if you compare us to a comparable market, Norway, which has got a lot of hydro as well, Norway has 4 times more storage in its lakes per capita, if you like, or per energy demand than New Zealand does. So we just don't have the storage. We've got a lot of natural lakes, and when we have dry periods of 2 or 3 months, those lakes deplete very quickly. We're very dependent on it. More solar and more wind in the New Zealand energy system will allow us to keep those lakes higher for longer and preserve that water for when it's really needed, which in the case of backing up solar would be overnight, or backing up wind when the wind drops off. So the point about all things electricity is it's the mix that's really important, and making sure that we've got diversity in fuel choices within that mix.
Awesome. Well, Mark, thank you very much. That was fantastic. And there are more questions. We'll get those to you. And if you've asked a question, we will we'll send out an email with some answers there. So yeah, really appreciate the time, and thanks again.
Look forward to it. Cheers.
So we have now the next speaker will be Kristen Lundman, and there's Kristen. Kristen is get my information here. Kristen is the co-founder and GM of Hatch. Hatch is a company that's really exciting. They're a digital investment platform that gives Kiwis access to the US share markets. And we're really excited to have Kristen on. She can talk about Hatch, about investor trends, about what's going on in US markets, but just another investment options for investors. So we're really glad to have you here, Kristen, and I will turn it over to you. And same thing, if you have questions, just fire them in and we will get them over to Kristen shortly. So thanks, and over to you.
Thanks, Doug. Sorry, I can't see all your lovely faces, but thanks so much for taking the time. on this, interesting season in life here in New Zealand to learn a little bit about US share markets. Happy to take questions. If you don't get your question answered, I'm really easy to find on LinkedIn or through Hatch, actually. But I am one of the co-founders, one of 4 of Hatch. We've been up and running for almost 3 years, actually. And we started with the US share markets, and there's a few reasons for that. But what I thought is I'd just go through some trends that we're seeing, particularly since lockdown and this whole pandemic has started, because I think the world has seen a significant shift. There's been a few iterations of investing platforms, the 1.0 back in the discount brokerages, right to the rise of Robinhood, and then of course some great options here in New Zealand. And so just want to chat to a little bit of that and the rise of this retail investor, but focused on the US share markets. The reason we love it is at Hatch, and why we started with it. It is the world's largest, most liquid share markets in the world. We know those 2 markets as New York Stock Exchange and the NASDAQ, particularly technology on the NASDAQ. So it's highly possible that a lot of the brands that that you use every day, that you're surrounded by, are listed on one of those 2 share markets, if not well-known Kiwi brands that we know, of course, on the NZX, but focused on the US share markets today. This is kind of tracking back to around 2000 on the US share markets, but even going back 150 years, we've seen on average about 10% year-on-year growth. That's historical average. And so if you were just to put your money in and set and forget, historically that would have gained about 10% on average, which is better than property, believe it or not. So it's the share markets are something that other countries, particularly where I've come from, Canada, have been very comfortable with. But in New Zealand, I think we saw that 89 speculative kind of crash, and we've been through a few market crashes since, actually. And I think it's not a go-to. It hasn't been a go-to like property has been in this country, but we're seeing that tide turned. And not only are people looking to their local markets and NZX and ASX, but actually they're looking to these large global markets now that it's really easy. Technology has allowed us to bring the cost down. We've been able to make it really accessible so that you can do it from your phone and basically build your portfolio in your pocket. But what you're looking at here is the S&P 500. That's the Standard & Poor's 500, which tracks the 500 largest companies, likely the most recognizable in the world, publicly listed companies in the US. They account for about 80% of the US share market. And so really the S&P 500 is kind of used as an overall indication of how the US share markets are going. And you can see those 2 arrows. You'll all remember the 2008 global financial crisis. Share markets dropped kind of up to about 50% during kind of its lowest point. And it took quite a few years to recover. So that's a memorable time for those that have been investing before that. And then, of course, the second arrow up top, that is the most recent crash called the COVID crash. And that was back in March of 2019. And I'm not sure if anyone remembers that, but for most investors, they of course do. It dropped about 34% at its lowest point. But interestingly with that one, because it didn't have the same systemic issues of back in the global financial crisis, it recovered quite quickly. And so you can see that we've had quite a strong market run from that time. So what I guess I just wanted to chat about a few trends that we've seen during these pandemics. So this is the retail brokerage kind of signups and traffic and interest. And what we've seen is that's just grown, of course, thanks to technology. But of course, we see the big spikes back in the pandemic. And you had this perfect storm. You had this share market crash. So a lot of those that had been through the global financial crisis thought, oh, maybe this is my global financial crisis, my time to get off the sidelines and into the share markets, and really view these share prices as good quality companies on sale because of these external events that were happening. There wasn't anything wrong fundamentally with these businesses. Of course, the exception of those that would be affected by the pandemic and of course couldn't trade, hospitality, travel, naturally, but there was the sense of this is a short-term event. We're going to recover from this. And so I have pretty good comfort levels that the world will return kind of to normal. Therefore, I'm going to get off the sidelines into investing. There was more time on people's hands. You'll remember many of us were in lockdown. Of course, the rest of the world has been in various forms of lockdown since that time. And what we've seen is investor behavior has skyrocketed 200% initially in terms of signups. We saw the same thing at Hatch, very, very busy during lockdown. People have a little bit more time on their hands. It's possible they're not spending. If we're fortunate enough to keep our jobs, we're not spending as much on travel or food at work, of course. And I suppose there's that lockdown boredom and picking up a new hobby, be it financial literacy, right to a new hobby of investing. So we've seen big increases during that time, and there's been some other notable increases that I want to chat about. And even in the recent lockdown, actually, we've seen an increase in probably about 75% of activity on Hatch. And so that just kind of goes hand in hand with people have a little bit more time on hands to put their money to work or to explore what's happening on the share markets. A few other really trends of note that I wanted to speak to, and this is goes hand in hand with this idea of democratization thanks to technology. Financial instruments are getting a lot more more accessible and easy to understand, but also this rise of this retail investor and actually catering to an entirely new investor that has quite different demands. And one is a move to managed funds and actively managed funds to a move into passive, what's called passive investing. Those that aren't aware, that's often otherwise known as an index fund or an exchange traded fund. Many of them are passive, though some are active. And what they do is they just track effectively a benchmark. And so you don't have humans involved in actively managing a fund seeking to beat the market. They're simply just tracking a benchmark. Of course, being the most popular one, that's the S&P 500. But we've seen huge inflows into passive, and the reason being is because they're simple to understand and they're actually relatively inexpensive. And so one of the most popular passive funds in the world is a Vanguard fund that tracks the S&P 500. That one's got a cost basis point of a cost of 0.03% is the cost of being in that fund, compared to a managed fund that can sometimes be around 1%. Again, those are humans that are trying to beat the market. You can see there's a huge difference, and there's a real rise in popularity. The big players, of course, being BlackRock and Vanguard. And so this is one of the trends that we're seeing. Another one we're seeing is the rise of SPACs and direct listings and IPOs. A quick tutorial on what the difference is an IPO is initial public offering. That's a private company that is seeking to raise a bunch of capital to deliver their growth on kind of their growth plans. And so they take a portion of their company, issue a bunch of stock, they sell that. It then is subsequently listed on the share markets for everyday investors like you and I to buy. Traditional IPOs are lengthy processes for businesses. They're very expensive. You have to pay investment banks a lot of money. You go on road shows, and there's often lockup periods in terms of if I'm an early founder and I want to sell my shares in that business once it's public, it's likely I won't be able to do that until about 6 or 12 months. So it's a very common form. We've seen a huge amount of IPOs come onto the US share markets over the last 3 years. Some of the more popular ones on Hatch have been Snowflake, Bumble, we've got Roblox, Coinbase, Rocket Lab. So actually, that's not an IPO, sorry. I'll get to that in a minute. Palantir, Roblox, Airbnb, CrowdStrike, Zoom. These have been some quite popular, Slack and Beyond Meat, popular IPOs. Then a lot of companies are starting to look, those that have strong brand recognition, look to direct listings, and they actually cut out the middle person, and so they can save a lot of money, move to the public share markets a lot quicker, but actually they're not looking to raise capital, and so they're not selling their shares to raise capital. It's often a chance to give those early investors in a business access to sell their shares immediately on the share markets to everyday investors. investors. So direct listings, a little bit cheaper, but you have to have strong brand recognition to do that. Spotify, Coinbase, and Roblox went ahead with a direct listing. And then, of course, there's SPACs, special purpose acquisition corporations, and what that is a reverse merger where a company will basically list a shell company on the share markets in anticipation of effectively merging with another business, and in the process taking that public. One of the most popular SPACs in the past year here in New Zealand was, of course, Rocket Lab. And why companies do that is it's very quick to market. They can often be a public-facing company within 4 to 6 months, but they tend to be relatively complex. There is about a 10% rate of failure that they don't actually go public. So you can buy shares in the SPAC before it turns into Rocket Lab, as an example, but there is a chance of that failing. Therefore, there is some risk involved. And of course, they can be speculative, of course, because it's kind of this latest trend. Another big trend that we've seen is the rise of ESG. For those that aren't aware, that's environmental, social, and governance. And what that is a business has a risk rating based on how their company impacts on the environment. So are they, polluters? What are they doing with their carbon footprint? We heard some great stuff from Genesis before, of course. Social is impact on the communities around them. Should it be positive or negative in terms of equitable pay, human rights abuses, that's that social piece. And then we've got governance, which is there strong, transparent governance over the business in itself. And so there's typically risk factors associated, and people increasingly want to know that what they're investing in, the business is also seeking to be sustainable in all of these areas. And I suppose the thinking is that if I am, operating in, good business practices, treating those equitably, not harming the earth, I will therefore be a more sustainable business and potentially be around for the future. So that is the going thinking. People are increasingly interested in ESG funds, and we see that that's quite popular on Hatch. Some other trends that we've seen, for those that remember GameStop or AMC, they've heard about that. That is the Wall Street bets. We saw a big increase of kind of these meme stocks and the rise of meme stocks, and people wanting to, I suppose, trade with these highly speculative stocks that really don't have great fundamentals behind the businesses, but nonetheless are moved very much by retail momentum. ESG in the pink, you can see that's been very much on the rise. Travel stocks have had their day. Growth stocks, which is why most people come and invest through Hatch, is to get access to these fantastic growth stocks available. And then ETFs, exchange traded funds, of which we've got about 500 on Hatch. We've seen that rise of passive investing and a big growth in that area as well. For those who don't know who Hatch is, we're backed by Kiwi Wealth, so we've got some serious backing. We want Kiwis to trust us to grow their meaningful wealth, and started with the US share markets. With Hatch, you own your shares, and so we do believe in that strong kind of activist investing where you have a say, you can attend AGMs, your questions get upvoted. So we very much care deeply about people owning their shares. And then, of course, we've got a flat fee structure, which is really fair and transparent as well. We're a growing team. We've got up to 60 and growing at the moment, and we've got lots of plans for the future. This is just what investors are investing in on Hatch. It's probably the most popular shares over the last couple of years on Hatch. No surprise that you've got your EVs, Vanguard, really popular fund manager, EVs and NIO and Tesla. ARK Invest is Kathy Wood's kind of innovation fund. She tends to look in the pioneers of tomorrow and bet big on innovation, and very much back that space. She's got about 8 ETFs, and they're very popular on Hatch, everything from innovation to fintech to biotechnology to space. And then, of course, you've got your Apples, Microsofts, chip companies, Virgin Galactic, space. We're seeing that take off with Rocket Lab as well. So no surprise, some of those brands. Here's some of the more popular funds that we're seeing on Hatch. These images were taken yesterday, a little bit of pullback in the market, hence the red on Friday. But of course, technology is again, people are coming to invest in tech, into innovation. Of course, the most popular S&P 500 there, and then clean energy and ESG. We're seeing an uptick in that as well. A couple clean energy exchange traded funds on there, and then ARK Invest, a couple of those as well. That is quite popular. So I think that is my time. I'm happy to take a few questions, but for those that have really frequent, some of our frequently asked questions about Hatch, feel free to visit this website. You'll kind of see an FAQs, talks a little bit about Hatch and maybe lockdown if you're interested in learning a bit more about investing or someone you love. But also it's got our FAQs, which have some frequently asked questions there as well.
Awesome. Oop, thanks, Kristen. That was fantastic. I'm not sure if my screen's coming on. We do have a ton of questions actually, and we'll get a bunch of them to you for time constraints. One of them that came up when you talk about direct listings, IPOs, and then that for sure gets people's interest. One question is, will Hatch be able to accept pre-IPO investing at some stage in the future?
Yes, we will. Great question. So we're working currently to do that. Our hope is sooner rather than later. It is another growing trend along with this democratization of you know, and the rise of this retail investor, is that traditionally in the US, these pre-IPOs, or it's actually just considered an IPO, but you get an IPO price for the share. They are reserved for institutional investors, think big banks, wealthy individuals like Warren Buffett. But we are seeing the last couple IPOs, a number of brokerages in the US are starting to get allocations for the retail investor. So we're working really hard on doing that.
Awesome, thank you. So I'm going to put the rest of the questions to you on chat or to you personally, and we'll get the answers out to everyone. But really appreciate that. That's fantastic presentation, great stuff. So yeah, thank you.
Thanks.
So our next presenter is Stephen Newman from eRoad. Stephen is the CEO of eRoad. eRoad's a fully integrated technology tolling and services provider. eRoad is the largest provider of road user charges compliance in New Zealand and a leading provider of health and safety compliance and fleet management solutions. So same thing for you, Stephen, and thank you very much for taking the time to do this. We will hear your thoughts and then get back with questions. So I will turn this over to you, and thanks.
Good morning. Today helping me with the presentation is Alex Ball, who is eRoad's CFO. So quickly, eRoad operates in 3 markets: New Zealand, Australia, and North America. We're a purpose-led company, which is around safe and more sustainable roads. Our customers in New Zealand range from the ambulance service to rural contractors through to city councils, the folks that make the roads, pretty well everyone over 90,000 vehicles. In North America, we're mainly in the professional trucking space, and more recently we entered in Australia, October 2018. The services we provide is we help our customers manage their fleets of remote and mobile assets, such as vehicles, if you're building roads, everything from yellow equipment, bulldozers, through to small assets. This slide here gives an example of what our services are. There is in-vehicle hardware that gets mounted in vehicles. In addition to a driver-facing display, there is also a dash cam that is looking at both the driver and also outside the window. We provide products to help our customers manage fatigue, their road user charging, provide information back for companies to manage their logistics. eRoad's claim to fame was being the world first to deliver nationwide electronic road user charging system in New Zealand. That got the company off to a cracking start, and we are now the lead provider in New Zealand collecting over $600 million of road user charging for the New Zealand government. Some of the attributes of the company is that we work on 36-month contracts, so we contract both the hardware and the software services, which are made up of applications that operate on smart devices in the cab and SaaS services delivered through to headquarters, to fleet managers, logistics, people, health and safety, etc. So we have quite stable recurring revenues. COVID was a significant year for most companies. We did continue to grow at 13%, not at the rate that we've typically grown at, but we enjoyed high retention rates. We did unfortunately lose a few companies to the economic peril of COVID. We typically are getting on average $58.30 per vehicle per month. When you look at how we have performed, we listed on the New Zealand Stock Exchange in August 2014, and it's a story of growth and expansion into that North American market and more recently into Australia. When we look at where the business is, we have set ourselves up for high growth. Alex will talk to a recent acquisition that we have made subject to Commerce Commission clearance, which we expect towards the end of October, and that's the acquisition of Cortex. I'll explain the various growth sort of thematics around what we're doing, and then Alex will be able to explain how Cortex help us meet those. So it doesn't really matter what country that you're in globally, particularly the three markets that we're in. Global telematics is seen as a key driver in helping our customers go through their digital transformation. When you look at getting more transparency through the supply chain and making connections or contacts with the drivers contactless, key demands from COVID, to help companies become more efficient, to help them reduce their carbon footprint, help them go on that journey of how they start using EVs within their fleets and decarbonising, how we help them with health and safety, and how we help them with driver fatigue. These are all things which are driving a rapid adoption of telematics. At the global level, projections for the next 5 years is accumulated growth rates of 19% and slightly higher than that in each of the three markets that we operate in. So as EROAD, we are very focused in having the most significant involvement in gaining market share at this point. You can't grow a market at 19% a year forever. So for us, it is about scaling up as quickly as we possibly can to enjoy that. Our customers are looking to us to help continue to deliver value to them. So there is a huge focus on how we can use technology smartly to help them improve their businesses, be it from an ESG perspective, a productivity perspective, a health and safety perspective. And it's also helping them do a better job for their customers. So with that, I will hand over to Alex. No, I've got, sorry, the slide here. This is some of the products that we've delivered in the last year. As we headed into COVID, we knew that it was not going to be a high growth for us because of the impact it was having on our customers. We did take the approach that let's use the time wisely and come out of this period with a much stronger array of products. So on the left-hand side, primarily in the North American market, the dash cam is used by our customers to help them when there is an accident. It's used in New Zealand, Australia, to help provide coaching to drivers to make them better drivers. EROAD Go provides navigation and also provides a logistics connection between the driver and the back office system. In New Zealand, the logbook application that operates on a phone replaces the paper-based system and helps manage driver fatigue. We then have E-Road Fleet Maintenance, which helps the service and maintenance of the vehicles and keeping them safe. And the pre and post inspection app, E-Road Inspect, provides the information from that into fleet maintenance. And then for micro assets, we have E-Road Wear, that for $3 to $5 a month, you can track small assets in the order, that cost in the order of a couple of $1,000s, which could be a concrete cutter through to scaffolding, etc. So this is the range of products that we've delivered in the last 12 months for our customers. I'll hand over to Alex to talk about the acquisition of Cortex and how that helps us scale up and maximize the opportunity we have in front of us.
Thanks, Stephen, and Morena Koto. So the growth that Stephen's outlined in the global telematics industry is one that we are very keen to tap into at the pace at which he talked about as quickly as possible. And what we have been quite clear about to the market for the last 18 months, 2 years, is that we will get a significant chunk of that through organic growth, and you saw that large and expanding organic growth chart earlier on in the presentation. But increasingly, as we scale from where we are to where we want to be, which is towards that 250,000 unit medium-term target, a lot of the growth will come through also from inorganic channels. So we have, again, talked to the market historically about a strategic rationale for how we would inorganically grow through strategic partnerships and through acquisitions. And that strategic rationale was really centered around making sure where we were looking to do those transactions is that we were doing it centered around technology and acquiring or partnering in technology solutions which were complementary or adjacent to our core propositions that we deliver into our customers, but those technology solutions needed to be proven into the market and therefore would have satisfied customer bases attached to it. And that was the primary requirements around that, and the benefit of having that where we could maximize the opportunity would be where there was a significant amount of revenue synergies that we could attract between the acquired organization and E-Road itself. With the Cortex acquisition, that is, as Stephen said, subject still to Commerce Commission approval, hopefully soon. All of those things are addressed, but because of the size of the acquisition of Cortex, Cortex is roughly 40% of the size of E-Road. This acquisition is truly transformational for E-Road. It moves E-Road's growth metrics forward in one stroke by 2 years, and is very, very important for all of our markets, but particularly the North American and Australian market, because of the position that Cortex has developed in both of those markets, particularly the US. And I'll talk about the US in a moment. What the transaction does do is it produces a very significantly increased product market fit into a number of verticals where E-Road has not played as significantly because it needed to make a significant investment to be successful in there. And I'm talking around those line items that are referred to at the top of the slide, like refrigerated transport, the concrete element of the construction industry. E-Road already operates in a significant portion of the construction industry, but the concrete part of that is something that's very specialized. And in the transportation sector, the less than a truckload, the LTL part of that is another part where we had not participated significantly due to the investments necessary. And in all of those areas, Cortex produces and delivers into EROAD through the acquisition a very, very well developed, almost best in class set of solutions that it's built a very strong customer base off the back of. It's also got an emerging vertical in the waste and recycling industry that it's developed some innovative and fairly disruptive solutions in the United States to deliver, and we believe that that will be a significantly expanding industry as we move together as two companies going forward into the US and potentially back into Australasia as well. The second key thing that the acquisition does is it really changes the game in terms of our participation into the enterprise customer segment. Cortex concentrate on enterprise and have enterprise grade product solutions, as well as a number of very significant key flagship enterprise accounts, which together with the ones that EROAD brings to the party now means we've got a very significant portion of our business that is servicing enterprise customer accounts. The third thing that, and as I said, is part of the strategic rationale for the acquisition, is that Cortex have a next generation Android-based platform, which we were looking to have to build anyway. And this allows EROAD the ability to effectively leverage off that new platform because it is already in market and with customers. And it also enables us to accelerate our own technology and product roadmaps, which we're going to leverage off the Android platform. So it really enables us to move more quickly as a products and engineering team, and of course, therefore, deliver more innovative and disruptive solutions into our customer base in all those markets. Along with all of that, because it's a proven set of solutions and platforms, as I said earlier, we also bring on board 64,177 as of 31st of March 2021 connected vehicles, significantly uplifting our market position in particularly North America, where there's at least 50,000 of those 64 connected vehicles, as well as Australia, where they have an established enterprise position, as I said, in particularly the construction industry. And so, as I said at the outset, it really increases our growth velocity, this acquisition, towards our medium-term target of 250,000 units, which is a position we believe we are then the masters of our own destiny in terms of enabling us to then take on a more significant expansion trajectory into the global telematics market over the next 5 to 10 years. If we move to the next slide, please. And in terms of the metrics, just to illustrate the point, on the left-hand side of the slide are key metrics from financial year 21, so year ending 31st March 2021. On the left of that left column is the EROAD's reported financial results and operational statistics. And on a pro forma basis, we've added then in Cortex's similar financials and operating statistics. So on a pro forma basis, as at 31st March 2021, that's what the combined business would look like. So you can see there's a very significant uplift in all of those metrics. At the bottom, there's an asset retention rate that looks to have reduced. That is purely because Cortex's fleet customers had a significant fleet reduction component to it, because in America, they have a lot of connected trailers, and trailers were, during the pandemic over there, put to one side and put on the road, side of the roads. And therefore, there was a reduction in customers' fleets. We're seeing some of that reverse now, and it will reverse over time as a more normality returns to those markets. And you can see on the right-hand side, what I was alluding to earlier around the customer mix. So the customer mix changes very substantially between the three markets. So EROAD was heavily driven by the success in the New Zealand market with an emerging North American and Australian markets. You can now see it much more balanced between the New Zealand and North American business, with again a more significant Australian presence, which will build. If you look then at the balance between enterprise and small and medium customers, again, you can see that it was at a 40% to 60% split, but it's now virtually 50-50. In fact, there's slightly more enterprise customers than we have as a portion of our book than small and medium. And at the same time, we've brought on a number of additional strategic vertical industries into the mix. So you can see it's a much more balanced mix of industries that our customers operate in that right-hand side, with, as I say, new industries like refrigerated transport and waste brought on board through the Cortex acquisition. We move to the third slide, please. Can we just move? Are we able to move on one? Thank you. Just takes a little bit of time. Really importantly, E-Road's purpose, as Stephen outlined earlier, is to create safer, more sustainable roads for the customers that we operate on. And we do that through providing solutions and products to our customers that allow them to operate more safely and more sustainably on those roads, and therefore to be able to do what they do at the same, if not better, levels of efficiency and effectiveness through that. Cortex also has a very similar purpose, and therefore we are very confident that the two organizations will come together very quickly and very in a much more complementary way in terms of the purpose and what we are both stand for as organizations. We are both very, very focused on, as I say, enabling our customers to operate more safely, to reduce accidents and serious injuries through the activities that they undertake through their fleets, and to deliver more sustainable outcomes in terms of how they operate those fleets across the industries they operate in. And as a result, for our society and all of the markets that we operate in, we will have not only a more productive society, but a more sustainable and a safer society, and more people will go home at the end of the day. And again, Cortex is in very similar areas in terms of enabling its customers to reduce its emissions and to be reducing wastage in terms of how it operates its refrigeration fleets, and in the construction fleets similarly. And in waste and recycling, we can identify how we can be much more effective in terms of managing the recycling component of that waste that's taken away. Cortex is a specialist organization, so again, E-Road is bringing on board really strong capability in and deep understanding of those industry verticals. As I say, the refrigerated transport and the construction, particularly the concrete component, and that waste and recycling set of solutions are ones that have been developed through a significant investment by Cortex in understanding, with a significant capability that it brings to it in terms of understanding the customer's industry and their needs going forward. So we're very confident that in all of those verticals, we can establish a strong market position in those verticals in the markets that we operate in, and as a result have strong growth. And at the same time, there is a strong probability that we'll be able to generate, and this is one of the key drivers for the acquisition, revenue synergies between the two organizations as we bring common account management to bear following the acquisition being formalized, where we were able to sell E-Road solutions into our Cortex customers and vice versa. And we do believe, as a result, there's some very strong revenue synergies that will come through over time. We move to the final slide. I think that's it. So Namihi Nui, and over to the coordinators for questions. Over to Doug.
Guys, thank you very much. Thanks, Stephen and Alex. Definitely have some questions there, and I appreciate the presentation and putting it together. A couple questions that came through, and I'll kind of try and tie them together. Talking about who are your main competitors, and how does, or do you have an acquisition? Is an acquisition strategy part of the kind of strategy going forward, and how does that impact the competitive landscape that you guys are looking at?
So perhaps I'll answer I can answer the acquisition strategy. It's very definitely part of the strategy. We, as I said, to participate in a 19% annual CAGR means that we need to be growing organically or inorganically. I think, acquisitions of the size of Cortex don't come along every 5 minutes. And so that was a tremendous opportunity for us to capitalize on. But we believe there will be others. We are on a partnering journey as well. So where we don't acquire organizations, we enter into strategic partnerships. We've done a number of those this year. The Seeing Machines is the partnership is the last one that was announced, but we've entered into partnerships earlier this year with Philips Connect, which is a best-in-class technology provider around trailer tracking solutions in the United States. So it is very definitely part of our strategy, and so you will see over time more acquisitions and partnering arrangements announced. They won't all be the same size as this, and therefore there will be other implications, obviously, around funding.
Excellent. Thank you. Sorry, Stephen, go ahead.
On the competitor side, why does EROAD win? Our roots start off with regulatory telematics. In order to do that, particularly road user charging, you need to have a very reliable system, high uptimes, very accurate sensors in order to calculate distance. From that information, we're calculating a road tax, and then we're collecting that money from our customers and then paying it to the regulator. So in order to be good at telematics, regulatory telematics, which is complicated, we need to take really complicated regulation and make it really simple, particularly when many of our customers using it in the vehicle are drivers, which they're not going to read big manuals and all the rest of it. So we need to make it really simple, and we are the masters of doing that. When you translate all the things that you need to be good at to do regulatory telematics into a enterprises organization, it's all the same thing. They need systems that are reliable, easy to use, accurate. When things go wrong, they want to have great proactive customer service, which we're absolutely known for. They're looking to us to be the technology partner to help them go through this digital transformation their businesses are going through. And the one thing that is really, really hard to do at scale in a complex, large-scale operating environment is being compliant with transport regulation. So we've seen over the last 5 years the strong move from our initial small to medium customer base to a lot of enterprise accounts. That means we're not losing small to medium accounts. We're just winning a higher number of enterprise.
Thank you. This will be the last question. There are more, and we'll get them to you, but the last question will be kind of a combination of which product makes up the biggest proportion of your revenue. And then you mentioned one of the slides about a target of achieving 250,000 units. When do you expect you'd hit that?
Okay, so the right way to look at it is kind of a bundle of services. So different customers will require different services. So from a New Zealand perspective, those customers which are doing a lot of off-road travel through the road user charging product, they can get a refund for the travel not done on the public road. But if you're operating in an urban area doing less distance, that's not quite so important. But for you, for that type of customer, that might be in moving groceries around, having good health and safety might be really important. So typically most of our customers subscribe to a bundle of services. So there's typically about 15 things we do. So depending on what industry they're in will determine kind of what bundle of services that they will get. So I think that's a really cool one. In terms of the 250,000, that came out of an internal challenge. So when we got to 100,000 units, we did some research across the 3 markets that we're in to understand how many companies had got to that milestone. There were 28, and they got there in 12 years. We got there in 9. We then said, okay, 250,000, how many had got there? And their number was 13, and they'd got there in 3.2 years. And the main acceleration was a result of both good organic growth, but also very smart acquisition, adding key product and capability to their businesses to allow them to grow quickly. So, we see Cortex as being a very critical foundational acquisition, but there will be others. As we're seeing as a thematic globally, there is a lot of consolidation as a result of just normal business, but I think COVID will accelerate that. So we would expect there would be good opportunity for other acquisitions further down the track.
Excellent. Well, Stephen and Alex, thank you very much. Great information, and awesome to hear the details on the Cortex acquisition. We will, there are more questions, but we'll get them to you. We'll stop the presentation here, and anyone in the audience that has more questions, as we said, just send them along, and really appreciate everyone for speaking up and asking questions to the panelists, and thanks to all the panelists as well. Stephen, Alex, Kristen, and Mark, really appreciate your time and taking the time to put things together. So thank you very much, and appreciate everyone attending, and we will see you on the next one. So thanks.
Thanks, everyone.
Thank you.